Howdy. So I think a lot of people saw the video by the HSBC head of responsible investing where he made the argument that climate change is not a financial risk at all. There was a lot of controversy about that, with some people agreeing and some people disagreeing. But it was really actually quite an interesting talk, I think. And he made a lot of points that I think we should investigate a little bit more deeply. And that's what I'm going to do in this reaction video. So without further ado, let's start.
Hello, everyone. It's a pleasure to be here. Thank you very much, Andrew, back in the salmon bosom of the FT. It's a real pleasure. I miss the place horrendously. The 10 years at Lex and at the FT were the happiest of my professional career, so it's a real joy to be back. You probably don't expect a speech title like this at a conference like this. I do have a beard, which is my one sop to responsible investing, but I can happily say that I'm probably the only head of responsible investing worldwide at a major bank who has never used the word journey, either in print or up on stage. And I take a very, very financial and investment view of the topic. And it's only 20 minutes till coffee. And what I'm going to do over the next course of the 10 slides is to say why I completely disagree with the presentation that Sharon from Deloitte gave a couple of presentations ago, and why climate change is not a financial risk that we need to worry about.
So let's start off by looking at the title, Why Investors Need Not Worry About Climate Risk. Because in some sense, this is really the key to everything you need to understand this talk. Now, we're not talking about investors like you and me in our 401k plan. You're talking about institutional investors. You're talking about CEOs. You're talking about corporations. And those people don't care about what's going to happen in a decade or two. They care about what's going to happen in the next few years. If you're the CEO of a corporation, you care about what your stock price is next quarter, next year. You don't care what it is in 20 years. That's the key thing to understand. From an investment perspective, climate change is not a risk. Now, just to make clear, there are other perspectives. You could take the perspective of a parent. You know, if you have kids, then you care about longer timescales. You care about the century timescale. If you care about humanity, you care about the century timescale. And on those timescales, climate change is an enormous risk. And we'll talk more about that as we go through this talk.
Heresy. I completely get that there is a competition for funding. I completely get that at the end of your central bank career, there are still many, many years to fill in. You've got to say something. You've got to fly around the world to conferences. You've got to out hyperbole the next guy. But I feel like it's getting a little bit out of hand. The constant reminder that we are doomed, the constant reminder that within decades it's all over. And indeed, Sharon said, we are not going to survive. And indeed, no one ran from the room. In fact, most of you barely looked up from your mobile phones at the prospect of non-survival. It's become so hyperbolic that no one really knows how to get anyone's attention at all. Now, I wouldn't normally mind that. 25 years in the finance industry, there's always some nut job telling me about the end of the world. I've dealt with gold bugs my whole financial career. The roof's going to cave down. Y2K. Does anyone remember Y2K? Anyone old enough? The lifts didn't stop. But what bothers me about this one is the amount of work these people make me do. The amount of regulation coming down the pipes, the number of people in my team and at HSBC dealing with financial risk from climate change. Last night, Target fell 25%. 25%. And people are asking the board of US companies to spend time dealing with climate risk.
A perspective like this makes complete sense if all you care about is the next few years. If you don't care about what happens in 20 or 30 or 100 years. If you do care what happens in 20 or 30 or 100 years, then decisions have to be made today about climate change, okay? We can't wait 20 or 30 years to make those decisions. If we want to head off disaster then, we have to be dealing with it now. And so this really reiterates the problem with this talk, which is they just don't care about anything that's more than a few years away.
I work at a bank that's being attacked by crypto, We've got regulators in the US trying to stop us. We've got the China problem. We've got a housing crisis looming. We've got interest rates going up. We've got inflation coming down the pipes, and I'm being told to spend time and time again looking at something that's going to happen in 20 or 30 years hence. The proportionality is completely out of whack.
Just to emphasize this point, if you want to head off a climate problem in 20 or 30 years, you have to start working on it now. That's the way the physics of climate work. There are lots of lags in the physical system, so you cannot immediately stop climate change any more than you can immediately turn a supertanker.
Now, interestingly, at the moment, markets agree, more or less, with me, despite the hyperbole, and this is a fun slide I put up just to annoy people. The more people say the world is going to end, and here I've looked at the number of incidences in all press around the world that use climate catastrophe. The number of times the phrase climate catastrophe is mentioned around the world, the higher and higher and higher risk assets go. In tandem. The more we're doomed, the higher prices go. How is that possible? So what's going on then? The Sharons and the Mark Carneys of this world need to tell us why prices are going up with our own demise. And there's really only three answers that are possible to old purists like me. Either the risk is negligible, which for investors is great. We get on with everything and fine, so no problem there. Maybe it's in the price. It's perfectly feasible that every single investor in the market, and there are millions of them, we all went to school and learnt about pricing theory, maybe it's in the price. In which case, if we solve climate risk, markets are gonna boom. And that's also fantastic for investors. Or the Mark Carneys of this world have to convince us all, including me, that every single one of us on climate risk is wrong. Every one of us. That's possible, but it's a big call to make.
So I think that the markets have priced climate risk in basically at zero or close to zero. At least not every industry. Things like insurance obviously are factoring in, climate change in, but most industries have factored in at zero because, again, they don't care about these long time scale events. They really only care about the next few years.
The first argument they often give is that it's going to hurt future growth. And we've all now seen the Kaya identity, and we're all talking about GDP, et cetera, et cetera. And a common argument, even used by the IPCC, is that it's going to hit GDP in year number, whatever it is, 2100. It's a long way away. They reckon it's going to lop off 2.5%. Their worst case models lops off 5%. What they fail to tell everybody, of course, is between now and 2100, economies are going to grow a lot. At about 2%, it's the red bar. At about 3%, it's the black bar. But the world is going to be between 500 or 1,000% richer. 1,000%. If you lop 5% off that in 2100, who cares? You will never notice. 2 years ago, GDP growth stopped. It was minus infinity. It was okay, mostly all right. Europe has a GDP per capita 40% lower than the US. Northern Europe, it's okay. 5% in the year 2100 is more or less irrelevant.
So now, this argument is completely wrong. And it's really completely out of date. It reflects the thinking from the fifth assessment report, which came out early in the 2010s. And whenever I see someone try to make this argument, I think about this tweet from Marshall Burke, which I have to admit I laughed at. In reality, we don't have any idea how much GDP is going to go down in response to climate change. Here's a figure of various damage functions, which again show the reduction in GDP as a function of temperature. And you can see they don't agree at all. And so we don't really have a good handle on this. And so here's the way I think about it. Here's why I'm very concerned about warming over this century on decadal and centennial timescales. And that is this. The warming we're going to experience this century, if we don't do anything about climate change, is a few degrees of warming, a few degrees Celsius of warming, say 3 degrees. Now, That is comparable to the amount of warming the Earth experienced coming out of the last ice age. And by comparable, I mean about 50%. Now, think about how much the world changed between the ice age and today. I mean, the ice age was a completely different planet. If we actually warm the world by a few degrees Celsius this century, we are going to remake the planet. The planet will not look like it does now. Now, it's possible, I suppose, that we can gracefully adapt to that. But if you look at the things that are already happening with just 1 degree Celsius of warming, things like the US Southwest drying out, Hurricane Harvey, forest fires, heat waves in the Pacific Northwest, you look at those things and you say, that's 1 degree of warming. What's 3 degrees of warming going to look like? Well, I'll tell you, it's going to look a lot worse than 3 times as bad as 1 degree of warming. And so you have to look at this as an enormous risk. And the thing you can't do is be confident that we'll be able to deal with this. And we'll pick this up again in a minute.
But that wealth is important because adaptation is going to be a key reason why not only the financial implications are going to be de minimis, that the actual lifestyle implications will be de minimis as well.
Look, let's be clear. Climate change is a huge financial risk. Just look at one city, Houston, and they're spending $60 billion on climate change adaptation. That's $30 billion for a storm surge barrier and $30 billion for enhanced stormwater infrastructure. And these impacts are directly linked to climate change. Now, you could say, well, climate change isn't causing crippling expenses yet, and that's right. But remember, we've only had 1 degree of warming. There are several more degrees coming down the pike.
Most people put up the charts of hurricanes and floods and they go up. What they don't often put up are charts of the number of people who die from catastrophes, the amount of losses as a proportion of GDP or output. Anything where you actually put a denominator on those statistics tend to look like that. Human beings have been fantastic at adapting to change, adapting to climate emergencies, and we will continue to do so. Who cares if Miami is 6 meters underwater in 100 years? Amsterdam's been 6 meters underwater for ages, and that's a really nice place.
So I think it's pretty clear what the flaw in this reasoning is. If Miami and only Miami were 6 feet underwater, it's certainly possible that we can invest enough money to, do something to make it a nice place to live. You can't really do the same things they do in Europe, like build seawalls. It really won't work for Miami, but maybe there's something else we could do. But the problem, of course, is that if Miami is 6 feet underwater, lots of other places around the world are going to be 6 feet underwater, places that don't have the resources to adapt. In addition, if Miami is 6 feet underwater, think about all of the other climate change impacts that are going to be happening. People are going to have to be running their air conditioners all the time. People are going to have to be building more freshwater infrastructure. I mean, this has the risk of bankrupting us.
We will cope with it. California's fire budget, and I don't doubt the science at all, there will be fires. But we do need to adapt. Their fire budget is only 1% of their state budget. It's 0.1% of their GDP. If economic growth continues how I expect it to grow, we can solve this through adaptation. And one of the tragedies of this whole debate, and which is what we obsess about at HSBC, is we spend way too much on mitigation financing and not enough on adaptation financing. And I'm sure most of you will agree with that. My point being that there will be winners whose share prices or values go up and down. There'll be losers whose share prices go up and down.
I think what bothers me about this part of the talk is how completely amoral it is. It's kind of like, when you say there are going to be winners and losers, it's like, during COVID, there are going to be winners and losers. Winners include companies that make caskets. So when you look at climate change, winners include companies that make seawalls and stormwater infrastructure and things like that. I mean, you have to look at this from what does society actually look like? I mean, if we're spending all of our money building seawalls and running our air conditioner, then we don't have money to spend on the things that people actually want to spend it on, like education, starting new businesses, innovation, research. I mean, a world with climate change could be a world that people don't want to live in, but you'd never get that perspective from this dude. I mean, always talking about his share prices. I mean, I don't care what the price of shares are if it's a world that I don't want my kids to live in.
And what we do is we spend a lot of time looking at, these are pretty cool, right? It even looks like the HSBC logo. Did you get that? So these are volumes. So these are, coal companies, industrials, cement companies. They're going to see falling volumes. Of course they are. Another thing I often hear is, oh, what about stranded assets? And oh, my goodness gracious me. What matters is those stranded assets versus the value of the underlying business. Take something very simple like a PE. What happens when you buy something on 10 times that is not growing, all you analysts? You are basically getting your money back after 10 years of earnings per share, right? You are paying 10 years worth of earnings per share for a company. So let's imagine, for the sake of the argument, that is the earnings per share profile of your industry, and then Sharon is right, the world ends and the bars go deep red at the end. For most companies with stranded assets, and even for tech, their valuation does not take into account anything that happens after about year 20.
So I think this is interesting, and I think really emphasizes what I said before. I mean, he even said in there, I think semi-jokingly, that if the world ends after 10 years, it doesn't matter because you've already gotten all of your money back. I'm sure he would say, well, I don't actually mean that if the world ended in 10 years, it'd be fine. But he really does mean that. I mean, that's actually how they behave, that they actually don't care what happens after that because they've made all of their money back, so it was a good investment. And, ultimately, this is why his title of the talk about why climate change is not a big risk for big institutional investors is probably correct, because that's how they view the problem. But that's not how you have to view the problem. And it's not how I think we should view the problem. We should not be setting policy based on what institutional investors think. If we do that, we're cooked.
At a big bank like ours, at HSBC, what do people think the average loan length is? It's 6 years. What happens to the planet in year 7 is actually irrelevant to our loan book. For coal, what happens in year 7 is more or less irrelevant. Now, the smarter ones among you will know for a growth company there's a terminal value and all of that sort of stuff. But in general, these sorts of companies aren't growing very fast. So the debate about what happens out here from a financial risk perspective, it's irrelevant. Don't care. But my final point, I guess, is an optimistic one. It's just before coffees. Everybody so far that I've listened to this morning has been quite doom-laden. Humans are spectacularly good at managing change. That is the long-run return of the S&P 500. That includes 2 world wars, that includes an oil crisis, that includes a financial crisis, that includes the pandemic. It goes up and up and up, and it will continue to rise at 6.5% real for as long as toast is toast.
So I think this is really a terrible argument. As I talked about before, we have no idea how bad climate change is going to be if we have a few degrees of warming this century, which is what we're on track for. And so this Pollyanna-ish argument that asset prices are going to keep going up, the market's going to do great, regardless of climate change, is just I think it's just something that's just made up. Further, the idea that the kind of disasters we lived through in the 20th century, things like World War I, World War II, and the OPEC oil embargo, the argument here is that those things are as bad as climate change over the 20th century. And let me just again remind you of the magnitude of climate change we're talking about. We're talking about climate change comparable to the climate change that we experienced coming out of the last ice age. That is an enormous amount of climate change. And again, there's no reason to believe that the kinds of things we experienced in the 20th century are in any way analogs for the impacts of that.
And the climate change won't change that either. Imagine you were in 1920 or 1930 or whenever this chart began, and we're at this conference and somebody said, Stuart, what do you think the effect on growth will be of carbon emissions over the next 100 years. And I'd get out my model, actually try to bring my team into the room and go, okay, well, there's a lot of gas-guzzling cars, there are a lot of ships, there's a lot of industry, that doesn't look very good, and we know that that goes into people's lungs. And we would put together a really, really nasty outlook for today from what we knew in 1930. We would never have understood the deindustrialization. We would never have understood the rise of the service economy. We would never have understood how GDP is getting lighter. We would never understand how machinery is getting more efficient. Likewise, we do have no idea what the next 50, 100 years are going to bring, but I can promise you in 100 years when my great-great-grandson stands up and pulls up that chart, it will look more or less the same.
He guarantees he's right. Okay, now that should give you zero confidence, because nobody really understands how bad it's going to be. I mean, I fully acknowledge maybe it won't be that bad, but I also recognize that it could be terrible. And if you don't understand that that's a possibility, then I think it's hard to take any claims you make seriously.
The log pattern will hold. And all I do is beg people in this room not to be so negative around returns. The markets are crashing around our ears today and yesterday for nothing to do with climate whatsoever. I implore our leaders and our regulators most of all, because I spend way too much time at work dealing with this, to show some perspective. And let's get back to making money out of the transition, because there are thousands of opportunities out there. We have $1 trillion car.